For a long time, insurance was one of the most reliable systems in the global economy, where individuals, businesses, and governments depended on it as a financial safety net that could convert uncertainty into stability. Because the basic idea was simple: you pay a small, predictable premium today, so that if something goes wrong tomorrow, you are protected from a massive, unpredictable loss. And this model worked extremely well for decades because risks were relatively stable, measurable, and spread across large populations, which allowed insurance companies to accurately calculate probabilities, price policies efficiently, and still generate profit while protecting millions of people. And this created a system where people could buy homes, take business risks, invest in growth, and plan for the future with confidence, knowing that unexpected disasters would not completely destroy them. And in many ways, modern economic growth itself became dependent on insurance, because without it, banks would not lend, businesses would hesitate to expand, and individuals would avoid taking financial risks. But the entire system was built on one critical assumption: that the future would behave somewhat like the past, that risks would remain predictable, patterns would repeat, and extreme events would remain rare. However, in today's world, that assumption is starting to break down because risks are no longer stable. They are becoming more extreme, more frequent, and far less predictable. And this is creating a situation where the traditional insurance model is being pushed to its limits, because insurance only works when companies can estimate the likelihood of events and spread that risk across a large number of policyholders. But when disasters become too frequent or too costly, the math stops working. And this is exactly what is happening as climate-related events, like floods, wildfires, hurricanes, and heat waves, are increasing in intensity and frequency, causing massive financial losses that insurers are struggling to absorb. And at the same time, new types of risks, such as cyber attacks, global supply chain disruptions, and economic instability are emerging, which are even harder to predict and model because they do not follow historical patterns. And this creates a dangerous situation where insurance companies are facing rising claims, increasing uncertainty, and shrinking margins, which forces them to either raise premiums, significantly reduce coverage, or completely exit certain markets. And this is already happening in multiple regions where homeowners are finding it difficult or even impossible to get insurance coverage because the risk is considered too high. And when insurance disappears from a region, the consequences are much larger than just higher costs, because without insurance, banks are less willing to provide mortgages, businesses face higher operational risks, and property values can start to decline, which creates a chain reaction that affects the entire local economy. And this is how a problem that begins in the insurance sector can spread into housing, financial markets, and broader economic stability. And at the same time, rising insurance costs are putting pressure on individuals who now have to allocate a larger portion of their income just to maintain basic protection, which reduces their ability to spend, save, or invest. And this has wider economic implications, because consumer spending is a major driver of growth in many economies. And when people are forced to spend more on essential costs like insurance, it reduces overall economic activity and slows down growth. And this trend is further complicated by the fact that governments often step in to support or regulate insurance markets, especially in high-risk areas, which can create additional challenges because while government intervention can provide short-term relief, it can also distort pricing signals and reduce incentives for risk management, which may lead to even greater problems in the future. And as these pressures continue to build, the insurance industry is being forced to adapt by developing new models using advanced data analytics, increasing premiums, and limiting exposure to high-risk events. But the question remains whether these changes will be enough to sustain the system, or whether we are approaching a point where certain risks become effectively uninsurable. And if that happens, the implications would be significant, because insurance is not just a financial product, it is a foundation of modern economic activity. And without it, many of the systems that support growth, stability, and investment could begin to weaken. And this raises a critical question. Has the world reached a point where some risks are simply too large, too complex, and too unpredictable to insure? And if so, what does that mean for the future of economies, businesses, and individuals who rely on this system for protection and stability? And this is where the real story begins. But if the foundation of insurance begins to break, the consequences go far beyond higher premiums or fewer policies because insurance is deeply connected to almost every part of the modern financial system. And once it starts failing, the effects begin to spread rapidly across housing, markets, businesses, banking systems, and even entire economies. Because without insurance, banks become extremely cautious since they rely on insured assets as collateral for loans. And if those assets are no longer protected, the risk of lending increases significantly, which means fewer mortgages, fewer business loans, and tighter credit conditions. And this alone can slow down economic activity because when credit dries up, people cannot buy homes, businesses cannot expand, and investments begin to decline. And at the same time, property markets start to feel immediate pressure because homes and buildings in high-risk areas become harder to insure, which reduces demand and lowers property values. And this creates a situation where homeowners may find themselves owning assets that are declining in value while also being exposed to higher financial risks. And this can lead to broader instability in real estate markets, which are often one of the largest components of any economy. And as this instability grows, it can trigger ripple effects in financial markets where banks, investors, and institutions begin reassessing risk exposure, leading to volatility and uncertainty. And this is where the problem starts to evolve from an insurance issue into a systemic economic risk. Because confidence is one of the most important factors in any economy. And when confidence begins to decline, people change their behavior. They spend less, invest less, and take fewer risks, which further slows down economic growth. And this creates a feedback loop where reduced activity leads to lower growth, which increases financial stress and further reduces confidence. And at the same time, governments are forced to step in more aggressively, either by providing subsidies, acting as insurers of last resort, or implementing regulations to stabilize markets. But these interventions come with significant costs because they shift financial risk from private companies to public institutions, which means taxpayers ultimately bear the burden. And over time, this can strain government budgets, increase debt levels, and limit the ability to respond to future crises. And this raises a deeper question about sustainability, because if risks continue to grow faster than the system's ability to manage them, both private insurers and governments may struggle to keep up, which could lead to a scenario where certain risks are simply left uncovered. And this is what economists refer to as uninsurable risk, where the cost or uncertainty is so high that no entity is willing or able to provide coverage. And when this happens, individuals and businesses are forced to bear the full impact of potential losses, which fundamentally changes how decisions are made. Because without insurance, people become more risk-averse. They avoid investing in vulnerable areas, businesses reconsider expansion, and entire regions may experience reduced economic activity and population decline as people move away from high-risk zones. And this can create long-term structural changes in economies where certain industries shrink, others adapt, and new opportunities emerge, but not without significant disruption. And this is already beginning to happen in subtle ways as companies adjust their strategies. Investors shift capital, and governments rethink policies to address emerging risks. And at the same time, technological advancements are playing a role in reshaping the insurance landscape with the use of big data, artificial intelligence, and predictive analytics, allowing insurers to better assess and price risk. But even these tools have limitations because they rely on